Hello, this is Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 143rd episode. Today, we will dive into the markets. Lots going on there. Our return guest is Mustafa Chowdhury, a seasoned global rates and macro analyst. During a 3-decade career, he has held senior positions in Freddie Mac, Bear Stearns, Deutsche Bank, where I had the pleasure of interacting with him, Blue Crest, Voya, and most recently Macro Hive. We had him on Kopi Time mid last year when we discussed at length the US fiscal and monetary policy outlook. Today we will discuss the US, but then we will widen the discussion because Mustafa has very interesting insights on international macro, especially pockets of value in EM assets, not just with short term, but also medium term perspective. Mustafa Chowdhury, welcome back to Kopi Time.
Thanks. It's nice to be back for the second time. Thanks for having me, Taimur.
Few things have happened since you and I last talked. But one of the things I remember from the Kopi Time episode of summer of 2023, Mustafa, is you had insisted that instead of looking at markets-based inflation expectation markers, which is sort of things that you and I do on a day-to-day basis, they're actually second best. And you asserted that we should look at survey-based inflation expectation. That's a superior indicator. So now we're sitting at the end of 2024. Do you still maintain that view?
Yes, I do maintain. I think it's a fundamental long-term issue for economists to address this measurement problem in inflation. What really is inflation? Because at the end, what matters is the inflation expectations and not the observed inflation itself. And we use observed inflation sort of as a proxy for inflation expectations. But inflation expectations could be determined by multiple other things, as often we cannot distinguish between the two. But this last few years in the US was a striking reminder that the inflation that the consumers feel was quite different from what the data was showing. And we saw the Michigan survey 1 year ahead inflation persistent at a fairly high level. And while we saw the CPI pieces of the core PCE, although stayed fairly elevated, would come down quite hard. So that sort of effect, you can tell that affecting the political outcome in the US. In all of the survey results, people still feel inflation. And so I know that it's very hard for economists to have a clear, concrete. We as economists need a concrete measurement of inflation. So we do have to go through this very cookie cutter approach, but we have to still figure out if there's few other estimates that reflect how people feel inflation. For example, the month before the election in September, when the CPI came out, everything was the inflation numbers, the headline numbers are good, core CPI was good. But if you just separated out the egg price inflation, it was 20% increase in egg prices. So anyone who are walking into a grocery store sees much higher inflation than the data, the CPI data subsequently that came out. And so that disconnect we need to address as market players and as well as economists. I think that's happening everywhere else as well. That this may be becoming even bigger as the income and wealth disparity around the world is going up. The consumption baskets of the overall aggregate consumption basket could be quite the one that's used in the measurement could be quite different from where the different percentile populations consumption basket is. And it's going to be more and more different, and therefore the measurement has to address that consumption basket difference by different segments of the population. So I think it's important, it needs to be addressed to be at least making the policy right, also the communication right to the from the government to the people.
Mustafa, what about the difference between a 12-month measure of inflation, which you and I would use to price bonds, we would use it to talk about
Right.
inflation expectation, but the average person seems to be thinking, in the last 4 years, my egg prices are up 30, 40%, and that's what I care about, not this artificial 12-month cookie cutter thing that economists do. So, do you think there's
Yes.
something going on there as well?
Huge. And I am trained an time series econometrician that turned into a bond portfolio manager. But a few things that I have learned quite well as a time series guy is that all this back history, 12-month-old history, really doesn't matter. It's already embedded in expectations, embedded in all the other relationships. What matters is what's the new information is just the month over month. And if you really want to take a little bit of the noise out, maybe the number that I look at is the annualized last 3 months average. I almost never look at the year over year. Only reason I look at the year over year is because I want to know what Fed's putting as an input, because it's too stale the previous 9 months. And so that needs to be also somehow addressed, because year over year is basically a stale piece of information, in my opinion. But it seems like because Fed puts that as an input to their models, market then has to be aware of that and discuss that. And I find myself kind of lost. Why do I need to know how far inflation has moved since the middle of last year or wherever, November last year? I need to know what happened in the last 2-3 months. And so, yes, that is from a pure information content point of view. That needs to be also something revised and looked at more recent data. But there are most you can reduce noise without having to bring in so much stale data. If the objective is to reduce noise in the inflation and all data, it just looks like a lot of noise, a lot of stale data in the process. So yes, I'm totally on that camp.
So Mustafa, I have a slightly different take on this issue, and hear me out for a second. So I think the 3 month over 3 month is a very good gauge of inflation momentum. And when we were sort of talking about the near-term inflation outlook, the momentum is, I think, a far better useful source of information than the stale data. I'm fully with you on that. But I think what I was alluding to kind of hit me during my trip to the US the week before the US elections, that when I talked to taxi drivers or grocery store clerks, they were talking about ultra long memory. They were saying that my grocery bill is up 40% over the last 4 years. You and I would say, they've gotten wage increases since then. So they're really suffering from some degree of illusion, or they're getting a systemic error in their way of looking at the world. But it seems to me that long memory in these elections played a role, because the Feds or the treasuries or the Biden administration's communication to the public was inflation was high in 2022 and it's been coming down steadily. To your point, some items have been volatile and they've gone up a lot. But generally speaking, the goods inflation problem we had in 2022 is gone. Commodity prices are well under control. But people didn't seem to believe that narrative at all, because they kept on demonstrating like a super long memory that prices are up a lot since 2020. Do you have any sympathy with that perspective?
Yes, there is this whole war between level versus change, and
Right.
it's a perpetual question in time series econometrics, not just in the inflation measurement. The level, we tend to use change or percentage change as new information, whether it's a year over year or month over month or 3 month, is how much new information that you want to have. But one of the observations, and it was striking after the GFC, is that level matters as well. Level matters if you have marginal changes month over month, year over year, which economists tend to think of, then change is enough, or percentage change is enough. But if you have a large shift, over, like a banking crisis or a COVID pandemic, then you have large shift. We had during the pandemic, we had large shifts in participation rate, for example, of actually massive shifts in the labor force participation rate in the United States. So when you have large shifts like that, then level starts to matter more, and you can't just have changes. And so the models, there are some approaches to that, the whole concept. I won't go into technicalities of this. The whole concept of co-integration, et cetera, has been developed to incorporate both levels and changes into this. But there are times after big shifts, after GFC, levels started to matter a lot, and then it start to matter less eventually. Now, after the COVID, we have big shifts in certain numbers. Now, level will matter for a while. Like rent's kind of starting to flatten out. But when I think of rent, I think of it's 30 to 35% higher than pre-COVID level. And so that's the only thing matters to me. So after 5 years, then the month-to-month changes or 3-month-to-month change will matter. So as policymakers, as well as investors, we need to take that into account. After large shifts, take level into account. Now, Fed had, prior to COVID, had a project to figure out whether they should do price level targeting or whether they should target interest rate targeting. And in fact, Williams, when he was at the San Francisco Fed, he had a paper on that, very detailed paper on that. And there was some movement in that direction towards this alternative targeting, but that would also be wrong because not all the time that price level matters, and sometimes price level matters, sometimes the rate of change matters. The important thing for the policymakers and investors is to know when to shift from one to the other. I'm going back to technical term again. This whole concept of integrated process and co-integration actually addresses some of this problem of incorporating level and change in the same model. And maybe that's the direction it should go, to capture both.
Right. I fully sort of, that point resonates with me heavily. I remember the years when inflation target was undershot, and you could argue that the price level, the gap between a 2% inflation line and the actual price level was widening. And then the argument, I remember Ken Rogoff talking about it. So then if you have a transitory shock and you have higher than 2% inflation, you should not intervene because the price level is beginning to catch up, not necessarily go over the 2% line. I think that sort of consideration played into the transitory camp to not the most useful and helpful outcome. Because the view was, if I look at it on a 10-year basis, I undershot, now I should overshoot a little bit. And I think that was a big problem in 2021, 2022.
That absolutely was. I remember going to seminars in 2018, 19, that there was this, people started to believe that the level matters. And so that's caused them to be too slow when the inflation spiked up in 2001, because they were thinking on average, they're still kind of 2% or haven't gone too far above 2%. So waited, or didn't work out very well at that time.
Right.
And similarly, I think that just to connect what's going on now, same thing with the Fed now in the other direction, with rates in the whole high easing cycle. So the hiking is kind of over. There's too slow to hike, and that made us take a long time to get the inflation back, not even to 2%. Even right now, we're still running 3-ish%. in core inflation, whether it's in fact core PCs, annualized 3-month average annualized is running at 3.3 right now in the most
Yep.
recent data. So we're still way above uh, Fed's desired level for that. So it's been how long? It's 2 years and 8 months that since we first started hiking, and we haven't still gotten inflation anywhere close to the desired level. And so there is this. I think that this clearly there was an error in beginning of the hiking, and now once you make an error, then there is more errors in the other direction in the beginning of the easing. And
Right.
and that's yeah, go ahead.
Now, just saying that slow to hike, but then very quick to cut. And now looking back in September and October measures, I mean, the market is saying you guys probably overdid it.
Is absolutely. And so there are a lot of so there's one is the level versus change confusion in the policymaking world. I think market is a little better in getting this than the Fed does, and I don't understand why. The Fed also has some problem in understanding few things that has happened in the last 13 years in the U.S. economy and the bond market, and that's the result of extremely long period of zero interest rate from 2008, late 2008 to 2015, and with a little bit of higher interest rate than zero again. And that zero interest rate period for a long time caused some structural changes in the system. So you cannot dial up rate and then dial down rate. Clearly, dialing up didn't work very well in terms of bringing inflation down back to desired level. Dialing down is also going to not work because it's changed the structure of the economy. I'll tell you a few examples on the structure of the economy. Obvious one that if you look at the manufacturing data, US looks quite slowing. If you look at the ISM manufacturing, for
PMI
month
is below
after month
50.
below 50. Yeah. If you look services, it looks like perfect. There is nothing going on. There's no sign of recession.
Close
and
to
it's
60.
Actually robust.
Yeah.
For month after month. So there's clearly the two sectors have clear dichotomy between the two subparts of the economy. And manufacturing is a significantly smaller part than services, but we still, our brain, we're programmed to look at manufacturing and think that this is going to, this is it, the economy is slowing down, but it is not. So that one's a more simple problem that I think Fed understands that it's not clear how do you look at the aggregate, because you wouldn't cut if you just looked at the services sector of the US economy. But the most difficult part is this bunch of path dependencies that has been created. It's not the level of the interest rates, or it's the path that the interest rate has taken. And people in the bond world that also spend a lot of time on options market and swaptions market understand how important path is important. The path of zero for this long that may created some major structural changes in the economy. First, the rates that people pay, the mortgage rates. Most homeowners are paying like 3 to 3.5%, maximum 4% mortgage rate in the US. So all these rate hikes from 0 to 4, 5.25 did not have any effect of majority of the homeowners in the United States. Only people that were affected were the newcomers, the new home buyers, and so their mortgage rate is a little high. So that part, I think Fed doesn't know how to incorporate that the biggest credit market is untouched by rate hikes. So it doesn't slow down anything. And second, and there's some generational issue that all the young people are paying a higher mortgage rate than a little older ones. So those are social issues that eventually will have to be addressed. But then corporations as well. Corporations turned out to longer maturity funding, so they're not affected much. They didn't get affected by the rate hikes as well. So the biggest credit component of credit in the United States, fairly untouched by this whole rate hiking cycle. Then there is another couple of more interesting things happen with this zero rate policy. One is that mostly from QE, that we supplied all these reserves to the banks, and the banks took those reserves. And when we look at Econ 101, macroeconomics 101, you increase reserves and the bank's balance sheet goes up, and you decrease reserves, balance sheet should shrink. In reality, it doesn't, because banks, as they take the reserve, they deploy it in their risk assets on their balance sheet, and they bought treasuries, mortgages, whatever it is, and they got the deposits higher. So when you start to do QT, it can't reduce its balance sheet to reflect the QT as the reserves are going away. And so Feds just cannot continue QT. So that's why they slowed down QT now. And eventually they'll have to stop QT fairly soon. So that's another thing, that the bank assets, bank balance sheets, all of that had a ratchet effect that the hike didn't affect it that much. In fact, if you look at the net interest margins of the banking system, it is now higher than the beginning of the hiking cycle. So, and the stock prices are actually bank index. If you look at the KBW, the bank index, that doubled since the beginning of the Fed hiking cycle. So you got another ratchet effect. And the third one is homeowners' balance sheets are like historic best situation. The last time, if you look at the debt to the mortgage debt to the value of homes, real estate ratio, it's now as low as it was at this low before 1960. So American households, most of them that own homes, are like untouchable by monetary policy. Feels very rich. And then their cash flows are still unaffected by mortgage rates. Same with the corporations, huge wealth effect. That's why no matter you raise interest rate by 5.25%, the demand remains fairly robust. Service sector working out quite well. Employment in solid shape. So I think that change was not fully understood. This path dependency, and I had myself personally had conversations with Fed economists that actually make these kinds of analysis. Most of them, because traditional economics doesn't cover this path dependency part. Traditional macroeconomics doesn't cover. It's more of a finance, option pricing kind of story. I think Raghuram Rajan has a good paper.
Yes.
On this recently on the bank part of the aspect of the path dependency, and then I'm starting to see few Fed working papers on the mortgage lock-in effect as well. But this is kind of late. Already decision window is behind. The banks have this, at the peak, they had minus 800 billion losses on their book when the Silicon Valley Bank was going down. And so you would expect, after all these guarantees and everything, that the banks would unwind some of that book of business and reduce that. But if you look at the bank balance sheet today, banks have done minuscule amount of reduction of the securities book on their balance sheet. And the reason they did a minuscule amount of unwind of their balance sheet is because the Federal Reserve has this multiple guarantee programs. And the big one was the bank funding, the program that you can get loan from the Federal Reserve at par when you put a underwater mortgage or treasury, and it's as a collateral. It's it's somewhere tapped somewhere between 200 billion to 300 billion lately, because some banks do have need funding, but it's not a stress for the overall banking system. But what it does is that it provides an optionality for a regional bank out there or a major bank out there with these treasury books, that what if we get into a trouble, then we can always go to the Fed and put this as collateral. So if we can do that, then duration is not really duration. So they hang on to it. And so if you look at the bank balance sheet now, nothing changed. They still have that exposure. So what would happen going forward? Clearly, they're betting that 5.25 is really high, and eventually interest rates will decline. And lo and behold, Fed started cutting rates. That we'll be out of the woods anyway. But the reality is, I wouldn't. I know market enough that if I were a bank treasurer or bank board, I would not make that bet, because you don't know which direction interest rate goes. I have seen 15% mortgage rates in the 80s, and that happens, and that can happen again. So that's a mistake. That's a path dependency, that plus the government guarantee, all of that combined create a banking system that keeps getting from the government, keeps getting bigger, but could have a much bigger systemic risk in the long run. But that may be a very long run. But that's kind of a distortion for the US economy, because banks just can't take unlimited interest rate risk without any worries, and very different from what's happened in the Europe, because
Right.
you have to do stress tests.
Mustafa, this reminds me of the series of essays Raghuram Rajan wrote about financial dominance. So we have fiscal dominance when
Yes.
you have a lot of debt, the system sort of captures the policy setting. Monetary dominance when you have too much of a bloated balance sheet. And now the point that you're making, that by repeated bailouts, you've sort of embedded certain bad behaviors in the financial system that actually captures your subsequent moves.
In a very big way. And that's probably driving the increasing bank valuation in the United States. It's just the premium for bad behavior. And the government guaranteeing bad behavior is, I think, explains, because if you look at the balance sheet size of the banking system, whether the assets or the deposits, it hasn't really increased meaningfully in the last 2 years. But they put it against the share prices, it's doubled. So that must be all the bad behavior premium that government is handing out.
That's a very, very apt way of putting it. Um, let's move away from the financial sector related distortions to the core of Fed policy making. We've had 75 basis points of rate cut in this cycle.
Right.
Doesn't seem quite clear to me where the Fed stands with December or the subsequent meetings. They're going to have pressure from Trump to cut, but the market is seeming to think that they will stand a little more forthright and not cut as much as they had even indicated a couple of months ago. So let's entertain a couple of scenarios, Mustafa. Number one, let's say the Fed wants to keep Trump happy and
Yes.
they keep cutting, even though you and I know it's not necessary. What will be the outcome from the bond vigilante side or from the curve side?
I think that, well, if you look at the market pricing right now of, it's now pricing a lot fewer cuts than it did even a few weeks ago. So the cuts have been taken out. We still have 50%-ish chance of a December cut still priced, and maybe one more cut from January to sometime between January to September, probably one more cut. And that seems like done as far as the market is concerned. So the market's not expecting a lot of cuts anymore, because market kind of realizes the the mistake here in cutting too much. Probably it was a mistake already to start the 50 basis point cut in September and replied by just interest rates going higher. We had like 60, 70 basis point increase in the 10-year rate, with the mortgage rate up like 70 basis points after the cut in September as a reply to the Fed, like, hey, we don't agree with you. And so that's the bond. As the rates were going up, especially mortgage rates were going up, I was looking at it as reminds me of those days that the long end just completely gives a different message and refuses to accept the Fed's policy. I think we are back in that. Fed got, I think, misguided a little bit because it believed in historical relationships. Two historical relationships that don't apply. One is the so-called Sum rule, which I think is completely, anything that happened in the past doesn't necessarily mean it's going to repeat. A relationship that happened in first place, there is not as many observations to call it a rule. And then start to believing it, and then so that was a mistake using some rule or talking about or believing it. And the second one is even worse. The curve was inverted for a while, and historically, the yield curve is inverted for so long, then it's preceded by then economy goes into a recession 12-month forward. And if you look at econometric analysis, yes, indeed, in the past that happened. So the yield curve was extremely inverted in like a hockey stick for 2 years and still was inverted until a few weeks ago. And so the common belief would be, oh, in the past, recession happened after that, so recession is coming. So that those things, historical relationships, kind of misguided the Fed because we had inverted yield curve for 2.5 years, and we still have a robust economy. So that inversion may be not a reflection of the economy, but more of a reflection of the technicals in the marketplace. And I won't go into that technical. There is a whole technical story that's caused the yield curve to be such hockey stick inverted during this cycle than in any other cycle. But that's a mistake that they did. But this bond vigilante is going to be big this time. And just thinking that, oh, Trump's first term, he did all these tax cuts, and it wasn't that crazy inflationary. Of course, COVID helped out. He could extend this tax cut again and do all these the commitments that he made on his campaign stops, and he delivers all of that. There's a lot of dollars that we're talking about in terms of deficit if Trump goes through all of those commitments. But he doesn't have the same fiscal capacity in this term as he had in his first term. So if he thinks that he can repeat the same this term, he's going to be making a major mistake. They take the tax, the extension of the 2017 tax cut. Another extension for another 10 years, its cost is the estimate is a $5 trillion additional budgetary cost. With all the fiscal capacity that was already expended by the Biden administration with the CHIPS Act and all the other expenditures, there's not a lot of capacity to just even to extend the tax cut to 10 years. They might do a trick, like do it only 4 years because Trump is going to be here for 4 more years, and then hand it over to the next administration. So then still we're talking about $2 trillion, just that. Then all the little things add up a lot. The tips going to be tax-free, or corporate tax exemption for companies that that bring manufacturing back to the U.S. Like that's tons of stuff add up to a big number. This time, the moment they start doing some of those, we'll have a bigger reaction in the yield curve, just because uh, there's not as much capacity as they had in the first term. So I think that plus the inflation is not out of the radar. The housing in the U.S. is really unknown factor in my opinion. If I look at the vacancy rate for apartments, still extremely low. So it's like a little change in the number of people looking for apartments could shoot the apartment rentals back up again. But I have a feeling that we're not out of the woods on some of the key parts of the inflation, components of inflation. Especially, I'm worried about housing a lot. The housing affordability is still at historic low. So all of those are going to be bring back the on vigilante. So we'll get steepener very fast in this time if the Fed eases more. So they do. My own bet is that they won't ease in December, even if it's priced 50-50 right now. But the vibe from Powell in his last conversation, it didn't feel like there is a. Some are saying that Goolsbee and a few others are saying, "Oh yeah, December is at play," but I don't think December is at play.
Right. And Mustafa, that statement from Powell actually preceded the PCE numbers, which came out yesterday. We're recording this on the 29th of November. And those PCE numbers
Correct.
were also not particularly helpful going into December.
Right.
So which part of the duration would you touch? Like not anything beyond 2 years? Is that where you stand?
Yes, yes. There is no. I wouldn't go beyond 2 years. I actually, myself, I like a little bit short on some of these. The SOFRs, like 2026 SOFR contracts, more like the Z5, for example, December 25. That sort of area is actually a decent short rather than a long, because there's still a little bit of inversion there, and that would go, I think, eventually go flatter and probably start to pick up some slope. And if you look at the nature of the slope movement for the last 2 years, it's basically between 3 months and 2 year, and the 2 to 10 is being kind of flat and moved parallelly with a little bit of variation around it. But we did most recently after the cut, we got the slope of the 2 to 10 slope come back positive, somewhat positive. But most of the volatility will be in the 2-year sector, I think. Between 1 year forward, 1 year is the sweet spot volatility, sweet spot short, in my opinion, and I like that. I like that myself. That's where it's going to be. Mortgage rate would be fascinating to watch. It's now back at where it was. The Fed started. Everyone expecting Fed to cut, and mortgage rates came down, and the Fed's congratulating itself that a 1% decline in mortgage rate. Now it's back up to where it was. So mortgage rate is going to be something to watch, because that's the most important interest rates in the U.S.
So one technical question on the mortgage market. So when I bought my house in Washington, D.C. a long time ago, there were 3-year arms, 5-year, 7-year arms. You can sort of lock in there, and then it becomes variable, all sorts of mortgage products. I now realize that those products have disappeared. I mean, you can get a 50-year fix for a 30-year. Why has that been the case?
It disappeared because historically, if you go back prior to uh, early 2000s, the 30-year mortgage was the thing. And when I bought home in DC also, I got a 30-year, just classic 30-year mortgage. Uh, there's a 5171 ARM was coming up during the 90s. Then it became very popular when in just heading up to the GFC for a couple of reasons. The government itself encouraged it. Greenspan, I remember, actually encouraged people to take in a testimony in Congress, take arms, uh, but most importantly, those are the products that were securitized mostly through the uh, private sector channels, and was especially with the lower credit like Alte, etc. Uh, and so those are the ones that the investors were not the traditional MBS investors. And so they overpaid and eventually triggered all of these subprime prices because there's overproduction on the private channel of securitization. And so after the GFC, that private channel was pretty much destroyed from the market making point of view, as well as from um, the investor point of view. All these foreign European little the pension fund in Iceland or places like that, they are all gone in terms of buying those products. So now most of the mortgage production and origination is through Freddie Mac and Fannie Mae, mostly fully guaranteed, and 30-year is where the production is. And that sector has died down. And unless the private sector securitization comes back up, you won't see that coming back up.
So that house that I bought in 2003 with a 723, I don't know if I could have afforded that with a 30-year fixed mortgage at that time. So I'm glad that it was there at that time. But I have sympathy for young professionals today who basically have to lock into those very high rates. Mustafa, you have such a rich background on the U.S. economy. We can spend a lot more time. But I promised our listeners today that we will not just talk about the U.S. and we will tap into your perspective on EM. There is a lot of pressure from the US fiscal side, monetary side, and we just talked about financial dominance as well. In the swirl of all these things coming out of the US, where do emerging market economies like China and India stand?
China is a whole story by itself. And I think that I have a few puzzles. One of them is this whole housing crisis in China, and that sector is still in almost like a depression level. If you look at the construction sector growth, for month after month negative in that sector, unsold homes. I did specifically travel around a little bit in China last 1 year to just see on my own these big apartment complexes sitting there empty, just to have a good feel for how the market eventually clears. So it's a kind of a one story from emerging markets, China, and I'll come back to the housing one. The other story is non-China, and that's the big vulnerability there is uncertainty of US monetary policy. It's clear, monetary and fiscal policy, it's clear to me that the US monetary and fiscal policy has become more uncertain and more having bigger swings in those policies, 5.5% increase in interest rates. And I don't know myself whether there's going to be another 5 coming up. And in terms of the dollar, the volatility of dollar, we've seen the dollar appreciate like crazy, but there's no guarantee that it won't appreciate another, yen goes to, I don't know, 170, 180, that kind of level. or it could go the other way around. The thing is that the emerging markets are becoming more vulnerable to these shifting policy changes in the US. And I kind of worry that I see some celebration in the sense that, hey, we got a few countries in trouble in the last cycle in the dollar increase, and a few African countries, we had Sri Lanka, and not too many because ASEAN countries have been very protected against these dollar fluctuations because of their experience from 1997, and so they have protected themselves somewhat better in the ASEAN. But we saw the vulnerability. And then what happens now if we get a situation where bond vigilantes really get aggressive and Trump keeps spending and tax cut, and we get another big increase in the dollar, then who is protected for that? Which is, if you looked at it about a year or 2 years ago, today's dollar is a tail scenario. And so another move, 10, 15%, 20% in dollar could be a bigger tail scenario. And who has reserves enough built against that, a dollar shift or a big fiscal shift in the US? I'm not sure. And the US runs a risk that most people are not thinking about is the reason US can spend like this is because and borrow like this is because the interest rates, real interest rates, the growth rate hasn't been too far below the real interest rates. But if the real interest rates and the growth rate gap becomes bigger and bigger, then the whole this cycle of dollar change and the interest rate change becomes faster. There are big increases in interest rate, big changes in dollar, and if countries in the emerging markets that are not prepared for that big changes could be affected, whether they have enough reserve buffer, because it seems like your economy can do perfectly, but if you don't have enough reserve buffer, then you are in trouble, or enough other protections like swap lines and etc. that countries have been working on. IMF has also promoted some of these swap lines, the regional swap lines in Asia, for example, they have worked on. The countries need to start protecting themselves because tail scenario in dollar can easily happen. So that's the tail risk is very high from the next moves in the US policy into emerging markets. On the positive side, some of the wars, like Ukraine war, may stop, and that would bring some stability in the system. Could be positive as well. But in China, I am perplexed because I have been so deeply involved in the subprime crisis in the US. I've seen all these pot dependencies created as a price to pay to stabilize the housing market, stabilize the economy, but it had some very long-term negative effects in terms of income distribution, wealth distribution, age disparity. That's probably not correctable in decades. So it's not, for China, it's not just like, hey, fund the banks and they would just or pump a lot of money into the home builder industry and clear that market very fast through some sort of subprime auction or something like that, as has happened. Private equity bought up all the homes in the US, cleared that subprime market, the 5 million, this massive number of homes private equity bought during post subprime crisis to clear the supply demand imbalance in that market. The supply demand imbalance, very large in China, could be solved by something like that. But if they are hesitant on doing that, doing small changes here and there, but letting those those sectors just take time and resolve. And there's a huge price to pay in terms of effect on the rest of the economy. And sometimes I feel that, this balance sheet recession is going to be much more costly for them. So they may as well solve this very quickly. Other side of me says that the solution that I have seen, and they have only one data point for a major housing crisis, and solution wasn't actually that great from a long-term point of view. So that's got to look for a new solution. And so I'm kind of torn, and I feel that they may be looking for a new solution. You see some package they throw to stabilize the markets, and then it doesn't go far enough. And maybe they're looking for a new solution that's different from our solution in the US. So yet to be seen in China, but I'm fascinated by what's happening there.
So
Fascinated
Mustafa,
that.
on China, before we go into India, it seems to me that they certainly don't want to follow what Japan did or did not do for 20 years with their housing crisis. And I think many
Correct.
people tell them just follow what the US has done. But to your point, it's not like the legacy of those 8 years under Obama when US had very lackluster growth and there was basically a balance sheet recession going on in the US, but the stock market was doing well because of QE and so on, is probably not also something that the Chinese want to emulate. I mean, the PBOC is at pains when I meet with them that they are doing some QE, that they're underwriting certain amount of bonds for regional governments
Looking on the
to buy
sides,
property,
yeah.
but very much on the side. I'm kind of amazed that for a country that is sort of communist, they still seem to be very fixated on certain private sector principles like moral hazard. And they definitely don't want that to
Right.
come back the way it has come back in the US. So who knows? Maybe they are coming up with a middle point, not as stifling as Japan and completely stuck, not overly proactive like the US, but I, like you, am
Correct.
impatient. I think that they should get a handle on it a little faster. Okay, and India, which is the darling of global EM investor community, any view on that?
I think there is I think that there's, if you look at the three markets, US, India, China, and try to figure out where you want to be. US definitely, right now the stock market valuation is 230% or something astronomical to GDP. And China is like something like tiny. So less than 50% or something really low to GDP. So the valuation relative to GDP seems like outrageous in the US, but I would still stick to the US because I'm seeing more of these policies, more of these expansionary policies ahead of us and government guarantees. So it's hard to be out of the US. But if you're in a very long term, China is not a bad place to be invested, given the valuation is at unbelievably low. But India is the most unknown to me because expectation from the market is very high, 7-8% growth to be sustained for decades to come. In reality, whether they can pull it off or not I'm not a big buyer into the India story because some of the key fundamentals are not there in India that is required for really a persistent takeoff. For example, education level, literacy level is nowhere close to where China was at this level. Mortality, infant mortality, child stunt, and every one of these human quality of life index, it's way behind. And how do you sustain a persistent 8% growth if your human resources are not ready for it? So I feel that there is a little bit of over investment in China, just with over investment in India, just because of the enthusiasm to shift out. There's no other place to go out if you are getting out of China. So India is the place. Few investments in Japan and Korea, but India was. But there is structural problems in India that, in my opinion, is not sustainable to attract that much investment. So we're seeing that's coming back down, whether it's permanently coming, it's a revaluation or a temporary reaction to to I don't know all the I don't know what it is. If it is going down a little bit, but it's somewhat like 10% down the Sensex.
Yeah.
Uh,
Yeah.
Not anywhere close to where it can go. So I'm fairly bearish on India. I think that China is great valuation, but I don't. And then US is like it's outrageous valuation. It's just 230% of GDP, the stock market valuation, but it's still going up. Every day it's going up.
Every day it's going up, and I
hard
think
to
all the way
not-
to January 20, it's hard to see anything derailing that. But after January 20, we might have a bit of a hangover.
Yeah, so it could be that buy the rumor, sell the fact kind of story, and we
Yeah.
might see a reversal by that time. We'll
Mustafa,
see.
when you were talking about there not being that many alternatives beyond India, and you mentioned Korea and Japan on the side, I was hoping you'll mention Malaysia, because I know you spent a lot of time in Malaysia, and there we have seen a big spike in investment in the last couple of years.
I that's puzzles me all the time. I spend a lot of time in Malaysia and starting to spend elsewhere as well, in Vietnam and elsewhere. And ASEAN, not just Malaysia, ASEAN is definitely undervalued in my opinion. That the and where I do and the if you look at the PP on a PPP basis, ASEAN is much bigger than what the reported numbers are. But generally, the vibrancy, the investments, like all the semiconductor industry moving into Malaysia, Vietnam. I was in Da Nang and Hoi An a couple of months ago, and the number of resorts that are being built along the South China Sea, you just boggle my mind. Like, so these are. Why are the stock markets there not going higher? What's the biggest puzzle of my life? I would be anytime, I will be in. I'm actually invested in some of these ASEAN part of the market, in the equity market, but why it doesn't go up more, and just puzzles me.
Right, and this region did have a golden run in the 90s. The Asian financial crisis sort of ruined it, but you would have thought that they cleaned up their banking system, their balance sheets through the 2000s, that this decade, over the last decade, should have been their moment in the sun. But they've really underperformed. But Mustafa, as you know, we at DBS did a joint report with Bain Consulting earlier this year, looking at Southeast Asia over the next decade. We're very optimistic. And when we began the report, Malaysia was not like at the top of our consideration. But as we wrote the report, looking at the tech investment flows, looking at domestic travel tourism industry, we've become quite constructive on the Malaysia outlook. But I think we need to put ASEAN conversation aside for another day. You have shared such rich stuff with the US and some of the large EM. Maybe we'll end it right there. Mustafa Chowdhury, I can't thank you enough for your time and insights.
Great, Taimur. Great to talk to you. It's
a real pleasure.
It's always fun to have this conversation.
Yes, and I think our listeners should know that you and I have conversations like this all the time without the recorder.
Yes.
Thank you very much to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. It is for information only, does not represent any trade recommendations. All 143 episodes of the podcast are available on Apple and Spotify. You can find our research publications by Googling DBS Research Library. Have a great day.